Good morning. Let's dive into how we can approach calculating the minimum daily profit for your Nasdaq Crypto Index option and Dow Jones option trades using a bear-put ladder spread during a bearish market movement. First, to understand the profit potential, we need to clearly define the bear-put ladder spread strategy and then analyze its behavior in a declining market. Understanding the bear-put ladder spread. A bear-put ladder spread is a bearish option strategy that involves buying one higher strike put option, selling one at-the-money put option, and selling another lower strike put option. All options have the same expiration date. Let's denote the strike prices as follows. K1, higher strike price, bought put. K2, middle strike price, sold put, typically at the money or slightly above. K3, lower strike price, sold put. And let the premiums be. P1, premium paid for the K1 put. P2, premium received for the K2 put. P3, premium received for the K3 put. The net cost or credit of establishing the spread is net cost credit equals P1, P2, PP3, profit and loss profile at expiration. At expiration, the profit and loss, P&L, of a bear-put ladder spread depends on the underlying asset's price, ST. If STK1, all options expire worthless. The P&L is the initial net credit or loss if there was a net debit. If K2 ST K1, the bought put at K1 is in the money, the P&L is equals K1 ST plus P2 plus P3, P1. If K3 ST, K2 D, both the bought put at K1 and the sold put at K2 are in the money, the P&S is K1 ST is K2 ST plus P2 plus P3 P1, K1 K2 plus P2 plus P3 P1. This is the maximum profit potential. If ST K3, all three put options are in the money, the P&L is K1 ST K2 ST ST K3 plus P2 plus P3 P1 K1 KU K3 ST plus P2 P3 P1. This region results in a loss, and the losses can be unlimited below K3 if we consider the short put at K3. However, the strategy itself limits the loss between K2 and K3. The maximum loss is realized if the price falls below K3. Calculating minimum daily profit in a bearish movement. Calculating a minimum daily profit with option strategies is complex and not straightforward due to the non-linear nature of option prices and the impact of several factors, including time decay, theta. Options lose value as they approach expiration. For put options, this decay generally benefits short positions and hurts long positions. Volatility, vega. Changes in implied volatility can significantly impact option prices. In a bearish market, volatility often increases, which would benefit the long put and hurt the short puts. Delta. This measures the sensitivity of the option price to a one move in the underlying asset. For put options, delta is negative. Price increases when the underlying decreases. Gamma. This measures the rate of change of delta. Here's a step-by-step approach to estimate potential daily profit, keeping in mind it's not a guaranteed minimum. 1. Define the specific trades. O, for the Nasdaq Crypto Index option and the Dow Jones option, specify the exact options contracts you've traded, the strike prices, K1, K2, K3, and the premiums paid received, P1, P2, P3. O. Note the time to expiration for each set of options. 2. Establish a bearish scenario. O. Define the expected daily downward movement for both the Nasdaq Crypto Index and the Dow Jones Industrial Average. This is crucial and will be based on your market analysis. For example, you might anticipate a 0.5% daily decline. 3. Use an options pricing model or simulator. OMS. The most practical way to estimate daily profit is to use an options pricing model, like Black-Scholes, or a more advanced model, or an options trading simulator. These tools allow you to input your specific trade details, the current price of the underlying asset, the expected daily price change, implied volatility, interest rates, and time to expiration. By simulating the change in option prices day by day based on your bearish scenario, you can observe the change in the overall value of your bear-put ladder spread. 4. Analyze the daily change in portfolio value. The simulator or pricing model will calculate the theoretical price of each option in your spread at the end of each day, considering the price movement of the underlying asset and the passage of time. The difference in the total value of your options positions from one day to the next will give you an estimate of the daily profit or loss. 5. Identify potential minimum daily profit, highly conditional. It's difficult to pinpoint a guaranteed minimum daily profit with this strategy, because the actual daily movement can deviate from your bearish scenario, and volatility can fluctuate. However, you can analyze the simulations under different slightly more and less bearish conditions to understand a range of potential daily profits. The lower end of this range, under your defined bearish expectation, could be considered a potential minimum. Important considerations. Maximum profit. Remember that the maximum profit for a bear-put ladder spread is capped at K1, K2 plus, P2 plus, P3, P1. And this is achieved if the underlying price settles between K2 and K3 at expiration. Maximum loss. The maximum loss is generally limited if the price falls below K3, and it occurs between K2 and K3. The exact loss depends on the strike prices and premiums. Break-even points. There are two potential break-even points at expiration, which need to be calculated based on the strike prices and the net cost credit of the spread. Early exit. You don't have to hold the options until expiration. You can close the spread at any time, and the profit or loss will be the difference between the initial cost credit and the closing cost debit. Daily profits can be realized by closing the position incrementally. Example, illustrative and simplified. Let's say for the Nasdaq Crypto Index option, you executed a bear put ladder with strikes at $100, $95, and $90, and the net credit received was $1. If the index drops significantly on a given day, the value of your $100 put will increase. The $95 put, short, might also increase but less so, and the $90 put short will also increase. The net change in the value of the entire spread will determine your daily profit or loss. To get a realistic estimate for your specific trades, 1. Provide the exact details of your Nasdaq Crypto Index and Dow Jones option trades, strike prices and premiums. 2. Specify your expected daily percentage decline for both indices. 3. Indicate the time to expiration for these options. 4. Mention the current implied volatility for these options, if you know it. With this information, we can use theoretical calculations, or more practically, simulate the daily profit/loss using an options calculator or trading platform under your defined bearish scenario. Keep in mind that predicting daily profit with certainty in options trading is impossible due to the dynamic nature of the market. The approach outlined above will give you a framework for estimation based on your assumptions. Please like, subscribe, share, and comment.